Is the stock market hitting an all-time peak and planning to reverse? Have you ever looked at the market and thought, okay, this has to be the top. Stocks feel expensive, everyone's bullish, the headlines are euphoric, and you're wondering if you should still be buying here or if it's time to get out. Today I want to show you what I believe is one of the simplest and most reliable ways to tell whether the market is near its peak. The easiest way to tell if the market is near its peak is by looking at company valuation. More specifically, the price to earnings ratio, or PE ratio, of the major market indexes. Don't worry, I will define each of these few terms here in a moment. All you have to do is, what is the current PE ratio of the S&P 500, or what is the current PE ratio of the Nasdaq 100? The search engine will show you a number, and that number represents how expensive the stock market is relative to how much money companies are making in profit. The S&P 500 represents 500 of the largest publicly traded companies in the United States and is widely considered the best overall snapshot of the US stock market. The Nasdaq 100 includes 100 big companies and is heavily weighted toward technology stocks like Apple, Google, Facebook, Tesla, Nvidia, etc. Now here's what the PE ratio actually means in plain English. The PE ratio, or price to earnings ratio, tells you how much the company itself is valued at versus how much money it makes in 1 year. It is how much investors are willing to pay to own the stock of a company for $1 of profit earnings of that company. So if the PE ratio is 20, that means the value of the company as a whole, the price tag on the company itself, if someone wanted to buy it, is the annual profit multiplied by 20x. Investors are paying $20 for every $1 the companies in that index earn in profit. If the PE ratio is 40, investors are paying $40 for that same $1 of profit. The higher the PE ratio, the more expensive the market is. To figure out if the market is near a peak, the next step is to look backward. Once you know the current PE ratio, you then look at historical PE ratios for the S&P 500 and the Nasdaq 100 and see what the highest levels have been in the past. Over decades of market history, you'll notice that these indexes tend to have valuation ceilings. There are certain PE levels that the market rarely goes above. When it gets close to that previous peak, that usually is a warning sign. It doesn't mean the market will crash immediately, and it doesn't mean the prices can't go a little higher, but it does mean the market is becoming very expensive relative to its history. When today's PE ratios are close to or above the highest levels they've ever been on average, that tells you investors are paying extreme prices for future earnings. That's usually what happens near major market tops. Let me make this very obvious with a real world example. Imagine a kid in your neighborhood runs a lemonade stand. He makes about $100 a day, which works out to roughly $36,000 a year in revenue. Let's say it costs about $10,000 a year for supplies. So his profit is around $25,000. You think to yourself, maybe I'll buy this lemonade stand. Maybe I can improve marketing, maybe even double production. Then the kid tells you he'll sell it to you for $1 million. You immediately say, no thanks, and walk away. Why? Because no sane person would pay 40 times profit earnings for a lemonade stand. Would you? I didn't think so. It would take you 40 years to make the money back if it stayed at the same level of production, unless you thought you could sell the stand to someone else for more than you bought it. That's exactly what happens in the stock market near major peaks. Investors take companies that earn real money and start valuing them at 30, 40, even 50 times annual earnings, even when growth doesn't justify it. At that point, prices are no longer based on reality. They are based on hope of a higher resale. When valuations get absurd, long-term investors notice, institutions notice, and smart money starts backing away. Eventually, the market corrects. This has happened consistently throughout history. One of the only scenarios where it wouldn't happen is if the US dollar completely collapsed in value, in which case stocks might trade at insanely high PE ratios, but your money would also be worth almost nothing anyway. Short of that, high valuations usually come back down. Now, can the market fall before it reaches a previous peak valuation? Absolutely. Markets don't need to hit old highs before turning lower. They can reverse at any time. But when valuations are at or above historical extremes, the odds of a decline become very, very high. The only way the market can sustainably move higher from there is if companies start earning significantly more profits, if inflation inflates nominal profits, or if pure hype takes over, like meme stocks and speculative nonsense, which almost never ends well. Interestingly, none of this affects how I trade. With 20-minute trading, I'm not predicting the market's direction over months or years. I trade short, structured setups. I watch the chart for 5 to 15 minutes. I wait for very specific criteria, and if it appears, I enter the trade. Most of my trades last about 1 minute. The market can be going up or sideways or down, it doesn't matter. If I win, I'm done for the day. If I lose, I'm also done for the day. As long as I win more than I lose, I'm profitable. If you want to understand this method more deeply, I run a free webinar where you can ask questions live and begin to understand how it works in real time. The link is in the description. If this video helped you, hit like, subscribe to the channel, and I'll keep putting out content that actually helps you navigate these markets. I'll see you in the next video.